On Business Incorporated today, we'll take a look at the impact of Russian invasion on African commodities markets. South Africa to begin new increased petrol and diesel prices tomorrow. In Ghana, Department of Justice reviews mining laws. Hello, welcome to this episode of Business Incorporated on Channels Television. I'm Ini John Mekwa. Well, we'll start with the markets as usual. It was all green amongst the markets that we track in Africa, with the EGX 30 recording the highest gain of almost 1.5% increase at intraday. It was followed closely by the JSE. It was up 1.16%. The NGX was also positive, but much lower, 0.41% as at noon. Kenya closed Monday session with a 0.14% increase. To the Middle East now, markets were similarly in the positive sentiment. In the UAE, both the Abu Dhabi market and the Dubai financial markets were up 2.17% and 1.28% each. Elsewhere in the region, Qatari index gained the most. It was up 2.50%, while Saudi Arabia notched up by 0.61%. Also, the economic ramifications of the conflict between Russia and Ukraine, topping conversations in Europe and around the world, I would say. We have Chris Kopp now joining us to tell us the update from Berlin. Well, Chris, amid Western sanctions against Russia, a growing number of companies are pulling out of the country. What's the latest?
Well, the grim reality of sanctions policy has made it to the entertainment sector, with Warner Brothers announcing it had pulled this week's release of The Batman from Russian screens. The move follows an announcement from Walt Disney Company saying it would halt the release of theatrical films in the country. Meanwhile, MasterCard said it had blocked multiple financial institutions from its payment network as a result of sanctions on Russia. Overall, the pullout of Western companies from Russia is expected to accelerate. Now, the most notable move in recent days, certainly the decision of energy firms BP and Shell to abandon multi-billion-dollar positions after the Russian invasion of Ukraine. These moves are again putting pressure on other Western companies with stakes in Russian oil and gas projects such as ExxonMobil and Total Energies to follow suit. Major auto and truck makers have already cut off exports to Russia, including Volvo and GM, and other companies are still considering options, such as Maersk, the shipper, saying it was monitoring sanctions against Russia and preparing to comply with them. One scenario included suspending cargo bookings. Now, the bruises that this policy of sanctions is likely to have on companies' bottom lines, that's something that investors are increasingly concerned about. And this concern has been weighing on stocks at the beginning of the week. Although they didn't produce concrete results, the talks between Russia and Ukrainian officials were able to limit losses on financial markets somewhat, but uncertainty is on investors' minds over what the impact of this conflict will be. That is the word from the floor, and that's the sentiment today as well, with Germany's DAX, in the early hours of trading at least, hovering around the level at which it closed on Monday.
Yeah, and in a tit-for-tat move, Russia has closed its airspace to airlines from 36 countries, including the European Union. That's after the EU announced its skies are off limits to Russian carriers. What impact is this move likely to have?
Well, it is bad news for a sector that has been hoping for a strong comeback after 2 years of dismal business during the pandemic. The sanctions have sparked flight cancellations and costly detours as they affect a key east-west flight corridor on the way to and from destinations in Asia, for example. And without access to Russia's airspace, many carriers will have to divert flights south, and that's not that easy, as they also have to avoid areas of tension in the Middle East. And the stop the step is not without controversy. The chairman of Italy's Civil Aviation Authority called the airspace sanctions against Russia a violation of international treaties. The EU insists, however, that the move had been, quote, carefully crafted in line with international law. The escalation could continue, with the U.S. possibly also closing its airspace to Russian carriers, the White House said. While barring Russian flights was not off the table, it had yet to make a decision. A move by the White House to ban Russia's carriers is expected to provoke a response from Moscow, which could affect carriers like United Airlines. The Chicago-based carrier, for example, uses Russian airspace for flights from Delhi. And it's not only airlines that are taking a hit here, it is also the aircraft leasing industry. It has been ordered to stop doing business with Russian carriers as well.
Wow. And as a result of all this, the German government has decided to up its defense spending. What's that going to do to companies?
Well, German defense companies are preparing to increase production as they find themselves in the middle of a wave of political support, which most of them hadn't dared anticipate in recent years. Spending government money on weapons in a country that started and lost 2 world wars is a highly sensitive issue, you can imagine. But with Russia's attack on Ukraine and the principles of freedom and democracy under attack, as many here view it, German foreign and security policy has changed dramatically. Now, to accommodate this shift, industry heavyweight Rheinmetall has already offered the German government the delivery of a large package of armaments. It would consist of ammunition, helicopters, armored vehicles, and tanks to the tune of 42 billion euros. That's almost $50 billion. Over the weekend, German Chancellor Scholz of the Social Democrats announced that his government aims to spend up to 100 billion euros, or almost $120 billion, in upgrading the country's defense equipment. That's on top of the state budget. Now, talks between political and industry leaders have been underway this week. Industry representatives saying that most production facilities in Germany are currently running a one-shift operation, which could quickly be extended.
All right, Chris, we'll certainly follow up on this story and see how companies and markets are reacting to it. Thank you so much. Enjoy the rest of your day. Let's go to Asia now, where markets rose on Tuesday as investors navigated the changing situation in Russia and Ukraine. Japan's Nikkei 225 gained 1.2% to close at 26,844.72. Other topics advanced 0.54% to 1,897.17. In China, the Shanghai Composite rose almost 1% to 3,488.84, and the Shenzhen Component climbed 0.25% to 13,488.64. Hong Kong's Hang Seng Index was up 0.38%. China's official manufacturing purchasing managers index for February was 50.2, beating analysts' expectation of a reading of 49.9. And the February figure is slightly higher than January's. January was 50.1. A reading above 50 represents expansion, and a figure below that signifies contraction. PMI readings are sequential and represent month-on-month expansion or contraction. Moving to Wall Street now, U.S. stock futures started March negative, falling Tuesday as investors continue to monitor the fighting between Russia and Ukraine. Dow Jones dropped 0.45%, S&P 500 futures were off 0.56%, and Nasdaq 100 futures slipped 0.63%. As futures fell, energy prices rose, with West Texas Intermediate crude oil up 3.31% and Brent crude climbing 3.8% to over $100. Analysts say that the Russia-Ukraine crisis will continue to produce market volatility, but the direct impact on corporate earnings should be small. Indirect risks are more substantial, given the effects of higher commodity prices on inflation, growth, and consumers. Well, go to the oil space now. Prices surged today as concerns over supply disruptions after Russia's invasion of Ukraine and related sanctions outweigh talks of a coordinated global crude stocks release. May Brent crude futures were up $4.02 to $101.99 a barrel, and the benchmark touched a 7-year high of $105.79 after the invasion began last week. U.S. West Texas Intermediate April crude futures were up $3.24 at $98.96. The contracts touched a high of $99.10 in previous day. Russia's economic isolation worsened as the world's biggest shipping firm, Maersk, on Tuesday said it would halt container shipping to and from Russia. Market analysts believe that the fragile situation in Ukraine and financial and energy sanctions against Russia will keep the energy crisis stoked and oil well above $100 per barrel in the near term, and even higher if the conflict escalates. The International Energy Agency is set to hold an extraordinary ministerial meeting today to discuss what role its members can play in stabilizing the oil markets. And in gold, prices eased today. That's in the metals market after strong performances in past few sessions as Russian and Ukrainian officials began ceasefire talks and Western countries ramped up sanctions against Moscow, dampening the demand for safe haven assets. Spot gold was down 0.3% to $1,902.15 per ounce after a more than 1% gain in the previous session. U.S. gold futures rose 0.2% to $1,904.80. Ceasefire talks between Russian and Ukrainian officials began yesterday at the Belarusian border as Russia faced deepening economic isolation 4 days after invading Ukraine. Russia's invasion of Ukraine is seen as a game changer, and demand for safe haven assets is expected to remain stable. Gold often has used a safe store of value during times of political uncertainty, and financial uncertainty has risen about 6.5% in February, having soared to an 18-month high of 1,973.96 last week. And in South Africa, another spillover of what's going on in Ukraine. From tomorrow, the 2nd of March, there will be a sharp price hike in both petrol and diesel prices. The price of petrol is set to increase by R1.46 per litre, taking the price to R21.60, while diesel will go up by R1.44 per litre, taking the price up to R19.49 per litre. The increases for March are mainly attributable to rising international petroleum prices as a result of the Russian invasion of Ukraine. We'll take a break now. When we come back, we have more stories from the African continent and, of course, how all of this is affecting the commodity space on the continent. So stay with us. It's Business Incorporated on Channels Television. Welcome back. You're still watching Business Incorporated on Channels Television. The global commodities market has been in turmoil for the last 1 year. Spot prices of commodities ranging from aluminium to coffee hit 10-year highs. Now, the Ukraine-Russia conflict has further triggered a rise in global commodity prices as traders battle with a fraught of geopolitical environment and an array of supply risks. Aluminium, for instance, has surged to a fresh record, while wheat advanced near its highest level in more than 13 years. We have Mayowa Igenao, a financial derivatives company analyst, to join us and tell us what else is happening in this commodity space and help us connect it, to what's happening in Russia. Hello, Mayowa. Good afternoon.
Hello, good afternoon. Thank you for having me.
Good to have you. So give us a direct connection between what's happening in the commodity space, because even before the Russian invasion into Ukraine, we saw that the commodity space was not very stable. So how do we now connect this to what's going on in Ukraine?
Well, like you mentioned before now, the commodities space wasn't actually stable. We had the pandemic, which disrupted the commodities market. We saw pressure tightening supply of commodities, which actually put pressure on the prices of commodities. And then looking at Russia and Ukraine right now, Russia and Ukraine are very important suppliers and producers of raw materials and commodities. Ukraine is known as the breadbasket of Europe. Ukraine produces about 12% of total wheat exports for the world. It produces about at least 16% of corn exports, and I think about 18% of barley exports. Now, together with Russia, they contribute they produce a third of the global wheat production. They produce about 19% of corn production and as much as 80% of some power exports. If you come to metals, Russia is controls about 10% of copper reserves in the world. US chip industry relies a lot on neon from Ukraine. And then when we now come to energy, the oil and gas, Russia is about the third largest producer of oil in the world. And they also are the second largest producer of natural gas. And the EU region relies a lot on Russia for their natural gas. We saw a spike in natural gas prices earlier in the year, and we saw what that actually did to the global economy. And then when you look at this, you can understand how these two countries are major players in the commodity space. Apart from that, when we now look at the transportation, the supply chain aspect of it, there's the Black Sea region, which Ukraine and Russia share a border on. And so this Black Sea region is very important to the movement of commodities from across Europe and Asia. And so this war is causing a disruption in that transportation of commodities. So this is actually impacting the prices of commodities that we're seeing and pushing up the prices as we're currently seeing.
And apart from this trade and commodities, Nigeria has a strong bilateral relationship with Russia, and that's in terms of the recent partnership to revamp their Jakarta steel mill, as well as a nuclear energy deal, which is supposed to be in the pipeline. What are the wider implications of this crisis on, looking at these factors as it connects to Nigeria?
Well, we can look at it from the import and the export side of it. Russia is where we import a lot of our imported food items come from Russia. For instance, number one, look at wheat. We use wheat for a lot of things. We have the important byproducts of wheat in Nigeria that we consume. We look at bread, we look at pastries, we look at pasta. Already, wheat prices have already gone up, and we saw the impact on bread. The price of bread, a loaf of bread now sells for as high as 500 naira per piece, right? So disruption in supply from Russia would mean that as we're already seeing, even more increase in the price of wheat globally. And what that means is that we would see an increase in the price of byproducts of wheat in Nigeria, like bread and the likes. And then that is only going to add to the inflation that we're already trying to stem in Nigeria. Then apart from that, we also import a lot of our seafood products from Russia. That's going to have an impact on us. And also refined crude oil, we import refined crude oil. What that will mean is that the government would have to be sourcing for more funds to pay for subsidy, and that's going to have a negative impact on us. So we're looking at increase in imported inflation right now if this crisis persists. And then we look at the export. Yes, we have oil prices above $100 per barrel right now, which is supposedly good news for us. But when you look at the fact that it's good news because we have increased revenue, increase in our foreign exchange, in our foreign reserves. But then when you look at the subsidy part of payment part, and also the fact that the price of oil is not, revenue is not only price, you also have the production part. So we have to be able to ramp up our production to be able to take advantage of the increase in oil prices right now.
So when we look at the fact that Russian economy accounts for about 3.11% of global GDP, is there a way that Nigeria or any other country, especially on the African continent, can cover itself from the risks, of these sanctions that seem to be coming every way to Russia?
Well, if you look at it right now, we're seeing the volatility and the uncertainty from this. We see the financial markets down. We saw the S&P 500 down, Nasdaq down, in financial markets in Hong Kong, Japan, all of it down. And then that's one aspect of it. Commodity space, we just discussed it. We're seeing increase in prices. And that's actually contributing to a fear that we could see an increase in global inflation in the short term. And then we look at the humanitarian aspect, oil and gas. All of this is showing that even with all these sanctions on Russia, nobody is going to win. It's still going to have an impact on the EU and other parts of the world. But what we'll probably see from other countries or top countries is to stem global inflation in their countries, we might see a tightening of monetary supply in these nations, in the US and other parts. We're already looking at a hike in interest rates in this month for the US. The fear is just that maybe they might increase it higher than they already intended to stem inflation in the US. And what this will mean for Nigeria is that we'll see an increase in our debt servicing costs. And looking at Nigeria is looking to raise money right now. What would happen is we'll probably have to, there are other sources of revenue for us that we can, or sources of funds for us. We can look at commercial loans, concessionary loans, and all of that. I think that's what countries like Nigeria and other African countries can do right now, source for loans from the IMF, from Afrexim, and also look for domestic loans. But we could say that, for the long term, Nigeria should think of the Dangote refinery, so we do not have to import refined oil, crude oil. We should look at boosting our local production. But these are things that cannot be done in the short term. There are things that we'll be looking at more in the medium to long term. So as of right now, it will just be a lot of sourcing for low interest loans from the IMF, World Banks, and the likes.
Yeah, Mayowa, well, it just says that trouble in one country is a trouble for the world, because, I mean, when we are looking for those other loans, then our debt servicing increase. We have been talking about our debt stock and, you know, where do we get the funds for projects when we are servicing debts? Not a good one at this time. But thank you so much, Mayowa, for sharing your thoughts with us. Enjoy the rest of your day.
You too.
So let's move to Ghana now, where we see that the Ministry of Justice, beg your pardon, Attorney General's Department is reviewing mining laws to give impetus to the fight against the poor ecological impact of mining in Ghana. The review will enable the country to reap the full benefit of its mineral resources to meet its development needs. In addition, the government is resourcing the Mineral Commission to empower it to effectively regulate the negative impact of mining. And while the Mineral Commission has been decentralized to regions and districts with adequate staffing to ensure it delivers on its mandates. And the Nigerian Content Intervention Fund has exceeded $500 million. That's according to the Executive Secretary of the Nigerian Content Development and Monitoring Board, Engineer Simbi Kesie Wabute. He says recently at the Sub-Saharan Africa International Petroleum Conference, organized in Lagos by the Petroleum Technology Association of Nigeria. Mr. Wabute indicated that the NCI fund, which is extended as low-cost credits to qualified oil and gas companies, covers asset acquisition, project financing, manufacturing, working capital, loan refinancing, women in oil and gas, and research and development. That's it for Business Incorporated for today. Thank you so much for being a part of it. I'm Ini John Mekwa.